Hello, everyone. Erik Brenner here with Hilltop Wealth and Tax Solutions, and I'm here with Matt Aurenz today. And we thought we would take a couple minutes and just give you an update on what's going on in the markets, and a lot of noise going on. And in this period of time, we want to make sure we over communicate with everyone. We really appreciate working with you. And we just want to make sure people are making the right decisions. So, Matt, we had our investment committee meeting on the 1st of April, and then it seems like from there it's been downhill and it's been a rocky road.
It has been. I think we are. It's obviously just the Liberation Day and experiencing what tariffs are doing, and I think the market is really just trying to decide what's going to happen. And I think I've been communicating to a lot of people is we're really dealing with two different beasts. We have the economy and we have the market, and they're not the same thing. And so the economy right now, data is still suggesting is relatively strong. Things look good. Markets shaky because they're trying to decipher what are tariffs going to do to the economy. So two completely different beasts again. And right now they're just not playing nice in the sandbox. But I think people are just trying to figure out where are we going, and they just want some certainty.
Yeah, we say a lot that the uncertainty markets just do not like that. And what I've noticed is, as we sit here today, stock market's down 16 to 18%, depending on what you look at. But, our models really have so far held up to what we want, right, is protect the downside. And so I think we just want to remind folks how we structure those.
Yeah, they've held up relatively well. Nobody likes to see accounts go down. I think at the end of the day, we've given up mainly just some gains that we were enjoying from last year, but we haven't hit negative numbers, which is good news. And we are beginning to see diversification obviously play out. So that fixed income market is holding its own. It's generating profits. It's generating yield. The Fed is still holding rates, so they're not climbing rates, they're not raising rates yet, and we still expect them to go on that glide path of reducing rates. So that diversification is helping. Even some international funds have paid off and done well. So again, I think the reality is right now we don't have anything that says de-risk fully, which is good news, but we do have that ability to reduce variance market or equity risk, by around 30%. So it's obviously something we're paying attention to on a very increased basis right now. But that does give us a lot of flexibility to make moves as needed.
Yeah, and I think the longer this goes, right? So no one knows for sure, but the longer it goes, the more potential we have of maybe slipping into a recession. And
yeah, I think that's the potential. I think at least on early ideas of that is a potential. The hard part is we just don't know exactly what the tariffs are going to impose for consumer spending, inflation, getting goods and products, that kind of thing. So we just haven't seen what the actual final data is going to look like. So there's a lot of just ideas of what that can be, which again, that assumptions traditionally don't pan out overly well. But yeah, I think most economists are in agreement that long-term prolonged high tariffs are not going to be good for our economy or the global economy for that matter. And so, so some stability there, creating deals, which I think is beginning to happen. We see that with Japan, we see that with Thailand, we see that with India. Things are beginning to happen, which is good. We just need, obviously we want to see that happen quicker.
Yeah, happen the quicker the better, right? But unfortunately, that's out of our control. And so we encourage people to, we talk a lot about risk and making sure that you're in the risk tolerance that, you're comfortable, and as you said, we make adjustments based on the data, not based on emotion.
Right.
And so, moving forward, how we want to encourage people to continue to think about this. We've been here before. It's been a lot of ups and downs over the years.
Right. We've had a good amount of ups and downs even just last year, where we've seen 3 to 8% pullbacks. So it's not anything new. This obviously just feels worse because it is a little bit more extreme right now. But I think at the end of the day is markets consistently long-term perform. So we just have to make maneuvers and shifting that makes sense based on the data, not emotions. But I do think that you have to be in the right risk tolerance at all times. That's obviously imperative to your long-term success and just ability to sleep at night.
Yeah.
And I think the other thing that people just have to remember is, you can control what you can control, and let's focus on those things. It's always a good time to review, what your spending patterns look like, and what your financial plan looks like. And when you start looking at those numbers, oftentimes it kind of puts things at ease as, okay, I'm still going to be okay even with market volatility. And so let's just focus on those things while we manage what's going on geopolitically.
Yeah, that's some good advice. So the positive side is a lot of the bonds have held up. That's helped our portfolios.
Yeah, correct. So we are seeing some good revenue off the bonds. We are seeing some price growth in the bonds. And, I think we'll talk about this next week a little bit more, but the recession indicators that we track, in February we saw three of the 6 were negative, which was concerning. And then in March we saw only 1 was negative. So we had a massive rebound in retail sales. We had a massive rebound in industrial production. So again, that underlying data is looking good, which creates stability in that fixed income market because the Fed is saying, hey, we are on the right path economically with inflation numbers, all of that. So they're not in crisis mode, which is good news, even though markets are responding on the equity side with a little bit more crisis mode.
Yeah, that's good. And cash along with bonds, cash because they haven't really lowered rates in quite some time. So those cash positions still are paying a pretty good interest rate. Right. So you can kind of look at that side saying, at least we're not down, below 1% in the cash yield.
Right. Yeah, we're still clipping a good 4.25 on money markets. So that's nice stability with good yield. There's a lot of positives out there. We just got to look for them.
Yeah, right. Exactly. Well, thanks, Matt. So again, I want to thank you. If you're a client, thank you for working with us. We're here for you. We got your back, and we're making sure we're staying updated on everything that we need to stay updated on. If you're new to Hilltop, thanks for watching this video. If your portfolio needs a tune-up, please feel free to reach out and schedule an initial call, and we can talk about that and kind of where you're at and maybe what needs to be adjusted. We are going to have a full-out first quarter update, and of course, with all the news that's coming rapid and fast, we'll cover all that information as well. So you can look out for that real soon, where you'll be able to send in questions and see the whole investment team together talking about how we see it and some steps going forward. So Matt, thanks a lot for joining me. Until next time, everyone have a great week. Thank you.